I use this chart to teach and show a concept based on the fact that the market has two states, a narrow state and a wide state. And you always have to know which state your stock is in at the current moment. Now, narrow state is simple. It's when your three items are close together. Now, those three items are the stock or the index itself, or whatever you're looking at, the 20-period moving average, and the 200-period moving average. Now, those are the only three items you really need, all right, to understand what state your stock is in. Now, when those three items come relatively close together, you are in a narrow state, all right? When your three items are they don't have to be touching, but they just have to be relatively close together, you're in a narrow state. But when your items are far apart from each other, you see? And if this 200 got extended down here, you are in a wide state, all right? So narrow state, wide state, separated apart. Your best opportunities will come from narrow states. Your best and most enduring opportunities will always come from a narrow state. Now, if you look at where we are today, this is not the time from a long-term perspective to be talking about new investments, is it? Can you see that? Based on this concept, this is not the time. If anything, this is the time that if you have been heavily invested in the market on the long side, as you should be seriously thinking about lightening up. All right? Okay. Now, this concept is not just applicable from a long-term perspective. I need you to use this same concept in your day trading. So let's go to a 2-minute chart of the NASDAQ, the same index. And let's talk about a few things. When you are far, here's your same moving averages on a 2-minute chart. So when your items are separated, look at the separation. Here's the item. Here's your 20. Go straight up the line, and there's your 200. You are more prone for a snapback to go back toward a narrow state again. When your items are separated, you are more prone to snap back to narrow the separation. When you are separated, I'm going to keep repeating it and showing you. You're typically very close to a snap back to bring these items close together again. When you are separated, and it goes on and on. And you can use, right, this concept to really initiate some incredible plays. And you can use this concept to truly improve on your accuracy. Now, I particularly want you to use the space concept that I'm talking about. It's a space concept. I particularly want you to use it with the 20-period moving average. So what I'm going to do So I'm going to spread this out a little bit. Let me see if I can spread this out. Yeah, let's do it like that. Now, last year, I did a study on my entire global team of traders, and I studied their losses, right? So I didn't want to see any gains. I just took the entire company's losses, and I filtered those losses into several categories. And something really interesting came from that study, that 83% of the losses of the losing trades were against the flow of the 20-period moving average. So 83% were against the flow, meaning that when the 20-period moving average is rising, they're trying to go short on that bar, right? And they're saying, like, for instance, the 200-period moving average is here. It's under the moving averages. It's a fat red bar. I'm going short, but it's against the 20-period moving average. So 83% of the losses were in that category. I believe, based on that study, that you can eliminate 83% of your problems if you ensure that the vast majority of your plays are in sync with the 20-period moving average. But you've got to incorporate this space concept that we're talking about today to make it really very powerful. So for instance, when you're playing with the flow of the 20, you want to find long opportunities, but you want to find those long opportunities at or near the 20-period moving average.